For Lombard Odier, the current economic model is WILD, which stands for wasteful, idle, lopsided and dirty. With me in the Finews studio to talk about what this means and the economic model it would prefer to see is Maxime Perrin, who heads sustainable investment at Lombard Odier Investment Management. Good morning, Maxime.
Good morning, Jade.
So can you tell me, what does WILD mean?
As you mentioned, WILD is a description of the current economic model. It's wild, idle, lopsided and dirty, and it's unsustainable. As we know, it has put huge pressure on the ecosystem and even on society. The conviction we have is that that model is going to have to transition to one that is circular, lean, inclusive and clean, or in other words, CLIC. Here, within the CLIC framework, you have the major challenges of transition: climate transition, circular economy transition, and even the social transition to a more purposeful society and one that is more inclusive.
Can you tell me what decarbonisation has to do with investing?
Yes, it has everything to do with investing for the next decades. There's a challenge that's been quite obvious since 2015 in the COP21, repeated at COP26 in Glasgow, embraced by hundreds of companies, thousands of companies, hundreds of countries. The challenge is to limit the rise in global temperatures to 1.5 degrees by the end of the century, and everybody now is in agreement that the challenge means decarbonizing the global economy by 2050. Retooling, if you like, the industrial base of the globe in an accelerated fashion away from fossil fuels. Investing is basically betting on the future, right? You buy a company's stock because you think it's going to rise. You buy a company's debt because you think it's going to pay it back. If you look at the challenge for the economy today, decarbonization is at the core of it. So as investors, we need to advise our clients on how to avoid the risk of failed decarbonization, or the opportunities that decarbonization offers. Decarbonization broadly is a challenge for transitioners, companies that today emit a huge amount of CO2 and need to transition. So if you think of steel making or cement making or plastics or transport or utilities, etc., or energy, you're still going to need all these things in 30 years. You're not going to go around with no cement, no steel, no plastics, and no transport. So these companies will need to transition in order to survive. And then you have the solution providers, the companies that offer new technology, new services that will accelerate and enable the transition to net zero. The key is to identify both, and not just to invest in the already decarbonized or the unconcerned sectors that don't have very much emissions, such as healthcare or tech. The challenge, in our view, is to actually invest in the transition itself. Find the companies that are leading the decarbonization effort.
Greenwashing continues to dominate headlines, with Deutsche Bank subsidiary DWS being the latest example. What can be done to stop greenwashing?
Greenwashing can be broadly defined as misleading investors about claims that you make. So claiming that you are implementing sustainable metrics or using ESG scores, or however you are describing what you're doing in terms of the stock selection or security selection, and actually not doing it. So misleading or lying to your investors about what you actually do. The reason why there's a lot of talk about this is, one, because there's obviously been a lot of abuse, and two, because we're finally coming to a moment of clarification from the regulator, from the competitive environment. The regulator, particularly in Europe, and certainly Europe is slightly ahead on this, is slowly but definitively providing a framework for investors to look at financial products in a comparative way. So that, you're going to report on the same metrics, you're going to provide the same kind of information as your competitors on your products. That provides clarification. Now, there will always be, exaggerations, people misleading their investors, and therefore there should be punishment for this. The thing is that I think that for a long time ESG was seen as a kind of easy way to market your products if you were doing the minimum, excluding certain sectors from your portfolio, for example. What we're seeing now with regulation, with targets, with decarbonization objectives, is that this is entering the system in a much more comprehensive and deeper way, and therefore what investors need to do is use the regulation to be able to define the advantages and disadvantages of each product that they're offered, challenge the advisors on the claims that are made, and from the investment community, from asset managers, we need to be very, very tight on the claims that we make compared to the actions that we take. This is not new to ESG. You should always do that regardless of the claims that you make. But it seems that the cost of exaggeration has now gone up to a level that will make people think twice about making claims that they can't back.
S&P recently threw Tesla out of its ESG 500 index because it failed to disclose its low-carbon strategy and business conduct codes, and because of claims of racism and poor working conditions. Did S&P make the right decision, and how do you go about selecting the right companies?
Yes, so Tesla is actually a very good example of the distinction that we like to make, or that we insist on making, between business practices and business models. ESG scores, the ones used by S&P for its classification, are overwhelmingly indicators, data points that reflect the practices of a company, how it treats its employees, how it treats its stakeholders, how it treats local communities, what kind of standards they have, how they deal with regulators, or in this case the SEC was the criticism for Tesla, basically how they behave as a corporate citizen. That needs to be distinguished from the business model. The business model is, in our view, just as important, if not more, from an investor's point of view, because it defines how a company will behave in the future in terms of growth, investment, and how aligned it is with the challenge of decarbonization or transition more broadly. Tesla has been criticized repeatedly for its behavior with employees, with unions, in addition to the events that you described. It's been criticized by the SEC multiple times, particularly its CEO. And even in environmental standards, it certainly isn't one of the best. However, you cannot deny that the business model of Tesla is well aligned with the transition. Its business is built around a decarbonized world, solar panels, energy storage, batteries, and electric vehicles. So when you want to select a company or a security with decarbonization in mind, you of course need to look at companies like Tesla, which are solution providers. They never made diesel engines or combustion engines. They're not a company that needs to transition. They're basically the archetype of the disruptor. They come into a market, they have a new technology, it answers a key demand, it has all kinds of advantages, and it disrupts its industry. And so you should definitely look at Tesla in that light. Maybe not at current prices, but that's a valuation question. But we should never forget the transitioners. When we talk about climate transition, too many investors look at the challenge as simply getting rid of carbon in their portfolios. Basically, you put a cap. You want to invest in low carbon because you want to be out of carbon or CO2 emissions in your portfolio. That's fine from an individual kind of almost selfish investor point of view. But if you want to look a bit further, you need to look at transition activities, transition companies, the companies that make steel, plastics, cement, transport, utilities, energy, because that's where the revolution is going to happen. That's where, of course, the risk is involved. A lot of these companies are too slow, too ingrained in their own processes, and not spending, not researching, not replacing. But a lot of them are actually true opportunities. They may emit a lot of CO2 today, but they are making the right investments, they're changing their processes, they are committed to decarbonize fast. These companies will have all kinds of advantages. And if you look at simply carbon emissions, you will discount them, exclude them, basically consider them as too risky, when in fact those credibly decarbonizing companies are those we should look at as opportunities. So in summary, when you want to invest in the transition, you pick companies on whether they are credible transitioners with huge opportunities in the future, and of course the solution providers that everybody gets excited about. But the two should be looked at as true opportunities, not just the providers of new solutions and the disruptors.
You talked about the energy transition. Which role does nuclear power play in this context, bearing in mind that Europe wants to become independent from Russian oil and gas?
On one hand, nuclear energy is decarbonized by definition. It doesn't emit carbon dioxide. So if you're an investor who wants to invest in the energy sector or the utilities, and you want to invest in companies that have already decarbonized nuclear power plants, EDF, Iberdrola, companies that have nuclear energy in their mix, are very attractive. Now, clearly, there's issues with waste. How do you deal ethically with the waste that comes from our nuclear power plants? And that's a debate that I think everybody has. I think we need not be too dogmatic about nuclear energy. For starters, to say that nuclear energy part of the solution or not is a debate that has run its course. You just look at the Chinese plan, the 5-year plan on decarbonization, and a lot of it is going to be carried by nuclear energy. The French government is reinvesting in nuclear power. It's not obviously the ultimate solution. It has drawbacks that are serious. But if the objective is to decarbonize, nuclear power has its place. And it's not, we don't need to build, I don't want to get into too much of a detailed debate on this, but we're not going to be dependent on gigantic nuclear power plants that we had in the 70s, for example. It's much more likely to be smaller plants that are built faster and probably safer. Our view is pretty neutral on this. If you look at the challenge for the European energy market, the first thing to do is get out of coal. Now, if you look now, we've basically gone into reverse, the reopening coal plants rather than closing them, which is unfortunate if you want to reduce your carbon emissions. So nuclear power is a part of the solution, certainly not the only part of the solution, but the idea that we can transition to a CO2-free energy source without nuclear power, I think that debate is now closed. It's part of the solution globally, and that's understood.
As a sustainable investor, what's your view on defense stocks?
So at Lombard Odier, we exclude, hard exclusion, any company that produces, distributes controversial weapons. That's a firm-wide policy applied to all funds, mandates, portfolios. Outside of that, there's a whole range of weapons that are not seen as controversial. And given the state of geopolitics, it's quite clear that not investing in the military, whether you're a state or a region or indeed an investor, is closing your eyes to the reality that modern warfare still exists. So I wouldn't have any issue with having defense stocks in a portfolio. Probably not a climate transition portfolio, to be clear, but more broadly in a broad allocation, I think defense stocks have their place as long as they fit the definition of conventional weaponry.
Very good. Thank you, Maxime. It was a pleasure speaking to you.
Pleasure to speak to you too.